I'm Christy Duffy for Smart Trend News. The world's most widely used search engine, Google, reported its second quarter earnings on Thursday after the closing bell. The company generated revenue of $6.82 billion in the quarter, up 24% year over year. EPS was $6.45. With me to discuss the numbers and what can be expected next from the search engine company is Clayton Moran, Senior Analyst on Internet Media and Communications. Welcome, Clayton.
Thank you. It's good to be here.
Clayton, what were your estimates for the second quarter?
The company did better than our estimates. The growth was actually better than the street consensus as well. They came in at 25%. We were actually looking for only 20%. On the bottom line, the $6.45 was a nickel shy of the street, but was about 20 cents ahead of where we were. So all in all, I thought it was a pretty solid report. Growth certainly was very impressive.
Okay, but I mean, the results weren't completely up to par with what the street was expecting. So can you give us an idea of what happened this quarter with the company?
Sure. So I think the street was a little disappointed in the bottom line EPS, which was about a nickel short of the consensus estimate, and maybe, even more short of sort of what people were hoping would be a beat. Google has a history of coming in ahead of the street. In this case, they came in slightly below, and that maybe is why the stock's selling off here about 5%. But also, the concern is really about costs. As I mentioned, the revenues were better than expected. Companies growing very well, but they're also growing their costs meaningfully, and that really reduced the cash flow that they created.
Okay, so EPS was below, revenue was up, costs increased, and they did see material acceleration in the U.S. market. How did Google fare in the international market?
Pretty well. I mean, we thought the revenue growth was strong really across the board. They broke it out in three different areas. The U.S. was up 26%. The rest of the U.K. was up 8%, although there was some impact from foreign currency there. And then the rest of the world was up 26%. So outside the UK, they had very, very strong results.
All right. Now, correct me if I'm wrong, but I have that before earnings, you reiterated your buy rating on the stock with a $600 price target. Now that you're looking at the earnings results for the second quarter and you've listened in to the conference call, what's your rating and price target going forward?
Yeah, we continue to like the stock. In terms of their position in the marketplace, they're still very strong. Obviously, the revenue indicates that they are doing very well. The cost, that's a little bit of a concern, but it doesn't really change the overall thesis on the stock. We think the investments make sense. Certainly, they seem to be paying off, and it doesn't change the bottom line much either. So when you look at the stock, it's trading at a very reasonable valuation, 10 times its cash flow, 18 times its earnings. For a company that's growing cash flow about 15% and growing earnings about 20%, that's a pretty attractive investment proposition. So we continue to like Google.
All right, let's talk about competition. So Google's dominance of the search space actually dipped by over a percentage point month over month when looking at June. Facebook is now adding Bing as well. So do you think that the space is becoming a bit more competitive?
Yeah, it probably is. I mean, Bing has ramped up things over the past year. Obviously, they're combining with Yahoo, so they're creating some scale, which will help them work with advertisers. They also are gaining market share a little bit in terms of search volumes. But in general, Google still remains pretty dominant domestically. The changes are really at the margin. And even if you look at some of the search market share numbers, you could argue that they're a little bit inflated for Microsoft and Yahoo based on some changes they've made to their web pages that really aren't incremental new searches. So, Google's still strong at about 65% domestically, probably 80% plus in Western Europe. So their position's pretty solid. At the margin, competition's increasing, but I don't think it changes the outlook much.
All right. And finally, Clayton, Google's stock price has fallen over 17% in the past 3 months. It fell 4% yesterday after market close on their earnings news. Would you commit new money to this stock right now?
I would. I mean, I think, the Google stock has well underperformed the NASDAQ, in my opinion, for no really good reason. People are concerned that the growth is going to really slow down. This report indicates that's not the case. And we think it's interesting, if you pull out the cash, Google has $93 a share in cash right now. The stock is trading at only 14 times this year's earnings. That's basically a multiple right in line with the S&P 500 index. So you're not really paying any premium for a great company with probably the best advertising company in the world, with very good growth prospects, a great brand, very innovative. I mean, there's so many good characteristics about Google that I think deserve a premium over your average S&P company. So we continue to like Google. I think the risk reward's favorable. We keep a buy rating on the stock.
All right. Thanks so much, Clayton, for your insight today. This is Clayton Moran, Benchmark Capital. I'm Christy Duffy for Smart Trend News. For more earnings coverage, make sure you're subscribed to our YouTube channel, Trade the Trend. You can also check our website, tradethetrend.com, for more headlines.